With interest rates rising in 2022, there's been less demand for certain types of VA loans, including the VA Streamline. However, other loan products have started to rise in popularity. And since there's a good chance you might not be familiar with some of these loans, today I'm going to go over what HELOCs, we like to refer to them as VLOCs, but we'll get into that, home equity loans, second mortgages, and cash out refinances are. And if you can't tell, it's Friday. Everybody knows when it's Friday, but if you're watching these videos on YouTube and you're hearing about them as they come out live, every Friday I wear red along with the entire staff here at Low VA Rates as a way to say thank you. We support you, our military. Speaking of red, down there in the right-hand corner of your screen, you'll probably see a red subscribe, follow, or like button. Do that so that when these videos come out, you are one of the first to know about them. So happy Red Friday, by the way. Now that you've hit that subscribe button, see, I waited, I gave you some time. Let's go ahead and dive into these 4 mortgage terms that you should be aware of. I mentioned HELOC, and I also said V for veteran. Huh? You like that? VLOC. But it's really a home equity line of credit. That's what HELOC stands for, right? We always talk about acronyms over here. Home equity line of credit. Just like the name implies, HELOCs are a way for you to access the equity that is in your home. However, this mortgage isn't a typical mortgage that most people are familiar with. See, with a HELOC, your first mortgage, the one that most of you have super low rates on because you got them in 2020 and 21, that mortgage rate and that payment with your normal mortgage will not change. Instead, this is a separate line of credit. It's a revolving line of credit, which functions sort of like a credit card, if you will, way safer, way better interest rates. So basically, like a credit card, when you borrow money on a HELOC against your home, you then have the ability to make payments on it or lump sum payments and pay it back, and then the amount of available credit against your home goes back up. Or as you draw on it, it goes back down, kind of like a credit card. So the interest rate on the HELOC is almost always a variable rate or an adjustable rate, just like your credit card. And that gets calculated like any other adjustable rate mortgage with an index and a margin. Now, because HELOCs use your home's equity as collateral, as I mentioned, HELOCs almost always have, not almost, I'm going to say always, lower rates than if you went out and borrowed money on a credit card or something like that. So they're always going to have lower rates than a credit card. Let's go to product number 2, a home equity loan. Okay? HE loan or V loan for you veterans, but it's really still just a HE loan. Home equity loans are sometimes called HE loans because they aren't variable lines of credit. They're similar to your first mortgage or a loan. But like a HELOC, getting one of these doesn't change your current mortgage rate. You still get to keep that super low rate on your first mortgage and that payment that you like. But unlike a HELOC, these are not revolving lines of credit, okay? HE loans come as a single lump sum of cash. So when you go and close, maybe you walk out with $100,000 in your pocket. Okay, and the amount of cash that you get depends upon how much equity you have in your home at the time, as well, of course, as any loan approvals or any sort of rules that the lenders might have. But for the most part, both of these, the amount of money you can get out of your home depends on how much equity you have. So if you're not sure what equity is, we've got a lot of videos out there on home equity. Now, HE loan interest rates are almost always fixed. I'm going to put back over here variable or ARM for the HE loan. I forgot to put that there. Okay, sorry, for the HELOC. And for the HE loan, also lower rates than credit cards. I really need to slow down. Sometimes had way too much caffeine this morning. Lower rates, and they are fixed. Almost always you have a fixed rate on a HE loan. This means that you have a specific repayment period. Maybe it's a 10-year, 15-year, 20 or 30-year, and you have a fixed payment. that you're going to make every single month. Now, these loans, the HELOANs, often come with closing costs such as origination fees, processing fees, recording fees, very similar closing costs to like a first mortgage. So if you only need one time, a chunk of cash, one big check for one specific reason, maybe a home renovation, you got to pay for someone's wedding, then a HELOAN might be a good option for you. I want to go into the third, what I was referring to as a product. It's really the third, I'm going to put it right here, second mortgage, the third term I want you guys to be familiar with, okay? These two are products. This is more a term. Second mortgages are a type of mortgage product, and then we use a vague and kind of general word, second mortgage. That's because it's more of a broader umbrella term that covers both the home equity line of credit that I talked about and the home equity loan. Basically, the term second mortgage refers to any type of loan that uses your home as collateral without having to replace your current mortgage, right? And that's what so many people are afraid of doing right now, because your current mortgage likely has a super low fixed interest rate on it. But again, when we refer to second mortgages, we are referring to HELOCs or HELOANs, both of them. You can use them interchangeably anytime someone's talking to you about a second mortgage. Now, unlike a refinance of your VA home loan, your VA first mortgage, second mortgages are not going to replace your first mortgage, which is that loan you use to purchase your home. And again, we're hearing this every single day on the phone or by text or by email. I don't want to go out and access all this equity from my home because I don't want to have to take my 2.25% interest rate up into the 5s. That's why second mortgages are so hot right now. Instead, you now are going to keep your first mortgage in place just the way it is, keep paying it back, and you're going to come over to low VA rates. You're going to get a second mortgage to access that equity, and then you're going to pay both your second mortgage and your first VA mortgage or whatever other type of mortgage you have simultaneously. Each month you'll start making 2 payments. In general, second mortgages usually do have slightly higher interest rates than the VA loan that you have, but that's because in a default, which means if you something happens and you can't make your mortgage payments, the first mortgage that you have, that VA home loan for most of our followers, takes repayment priority over the second mortgage. And the second mortgage is only going to get paid if there's anything left over after foreclosure or BK, or that somehow you've sold your home in the event of a default. Now, because foreclosed homes typically sell for less than what's owed on them, there might not be much money left over, or anything for that matter, to pay off the second mortgage. Now, in order for lenders like low VA rates or anybody else out there to offset the risk of having a mortgage in second lien position, lenders are normally going to charge slightly higher interest rates. So keep that in mind. Now, fourth thing we're going to talk about, cash out refinances. We love the VA cash out refi. Let's talk about that. You've probably already know something about this since we talk about it a lot. But we wanted to come in again and talk about it today and contrast it a little bit with some of these other terms that you've now learned. HELOANs, HELOCs, second mortgages, cash out refinances, all of these loans allow you to tap into your home's equity. However, unlike the other terms, cash out refinances will actually replace your first mortgage. When you do a cash out refinance with the VA, or conventional or FHA, but I'm going to focus on VA right now, you will get a single lump sum of money based off of the difference between your home's current value and the current mortgage balance on your VA loan. You will need to pay closing costs in order to access the equity in your home. Unless, of course, you do a no-cost loan, which go look on our YouTube video for how to do no-cost loans. But generally speaking, you're going to go out and you're going to pay some closing costs, like the VA funding fee, like the origination fee, like the appraisal. You're going to pay all those costs. However, since cash-out refinances are a first mortgage, that's the type of loan they are, rates for cash-out mortgages will tend to be lower than the HELOC or the HELOAN, because there's not as much risk if you're using a first mortgage. Now, depending on the type of cash out you get, you may not have access to a whole lot of equity. Don't forget, conventional and FHA cash outs only allow you to go up to like 80% of your home's value. VA loans, on the other hand, and why we love them, you can get 100% of your home's equity in the form of a cash out. So hopefully this overview has helped you better understand these 4 different terms and these options that you have to access the equity in your home. If you've got any questions, I want you to reach out. You can call us, you can text us, you can chat us, you can just submit an inquiry on our webpage. You can even comment in this video and we will get back in touch with you. Just to summarize and close this whole thing up, right now the reason I want you guys to understand this, most of you have very low interest rates on your existing VA mortgage, but you're also sitting on historical amounts of equity. We're kind of in a recession. Gas prices are high. If you want to get this equity out of your house, you can do it through these ways, but many of you are afraid to take a higher interest rate than the first VA mortgage you have right now. That's why we've been focusing on these new terms, and this is still an amazing opportunity to access your cash. So give us a call. Make sure you're wearing red. Watch us here on YouTube next Friday at the same time.